I'm very excited to introduce our next and final panel of the day. We have with us Nydia Ngiow, who is the Managing Director of BowerGroupAsia. We have Shamika Kundu, who is the Chief Strategy Officer for TruEra, which is an AI management company. And we have in the center, we have Sheldon Go, the Director of Worldwide Financial Services at Microsoft, which I don't think needs to be explained to anyone. They're going to be speaking with us today about digital trade, fintech, e-commerce, and kind of all of explaining all of the things that go along with that, as that is an increasingly important area of reporting for business journalists generally, and especially those who have to focus on trade. So with that, let's give them a hand. Thank you.
So today I'm just here to talk to you about digital trade and specifically how that has been handled in terms of international trade agreements. So I think you guys had a session maybe the past couple of days with Deborah Elms. So I do apologize if some of this is a little bit repetitive. So I just wanted to, set the scene a little bit and kind of walk you through how digital trade has been handled in international trade agreements, but have some, statements for you guys to consider. First of all, one, digital trade is not really a new issue. I know everyone's talking about digital economy agreements and how, this seems to be the new way of trade agreements these days, but I'm just here to say that, this is an issue that has been handled for over 25 years. It's not something that's like relatively new or groundbreaking in that sense. And I noticed that this is a bit of a regional crowd, but most of my examples are going to be fairly Singapore-centric, and for that I do apologize. And also, while Singapore tends to be moving towards digital economy agreements, I don't think that you can necessarily separate digital economy or digital trade from what is the typical traditional trade issues that you find in a free trade agreement. And of course, with the next big thing being the Indo-Pacific Economic Framework, I think it remains to be seen how groundbreaking this will be. And if you guys are wondering, why I'm talking so much about all of this international trade stuff, or why I'm here, and introduce, of course, that I'm part of BowerGroupAsia. But for most part of my career, I was actually an international trade negotiator with the Singapore government, negotiating the Trans-Pacific Partnership as well as the EU-Singapore FTA. So this is actually an issue that's very near and dear to my heart. So maybe I can start first by talking about how actually digital trade issues are issues that have been discussed for close to 25 years. We start out with the Information Technology Agreement. This is a plurilateral trade agreement enforced by WTO, concluded in the first Ministerial Declaration on Trade in information technology products in 1996. And this agreement was expanded in 2015. But basically what it looks to do is to lower all taxes and tariffs on information technology products by signatories to zero. And then in 1998, trade ministers agreed at the second WTO Ministerial Conference to not impose customs duties on electronic transmissions, which has since been known as the moratorium on e-transmissions. And at the latest Ministerial Conference that took place in June this year, WTO members actually reached a provisional deal to extend this moratorium on applying duties to e-transmissions until the next ministerial meeting, which is most likely going to be in 2023. Digital trade issues was also discussed very early on in the days of Singapore's first couple FTAs, notably in the landmark US-Singapore FTA, when the then IDA, or our currently the Information Media Development Authority, negotiated the commitments on telecommunications and e-commerce. During this time, negotiators had to consider how international trade disciplines, which were then very clearly divided into trade in goods and trade in services, should treat products and services that were purchased, traded, and consumed entirely in electronic form over the internet. There were not only ICT aspects in telecommunications and e-commerce, but there was also ICT-related aspects in chapters such as government procurement and intellectual property rights. Nevertheless, we see that in FTAs going since then, since the USS FTA, that digital trade, digital economy is usually covered in chapters like e-commerce or telecommunications, whether it is for the Regional Comprehensive Economic Partnership or in the Comprehensive and Progressive Trans-Pacific Partnership. So you'd think that since 2003 we've been discussing these kinds of issues and we'd have greater clarity in 2022. But maybe you can see where I'm going with this, but even in Singapore's digital economy partnership agreement with New Zealand and Chile, there is a footnote that states, the definition of digital product should not be understood to reflect a party's view on whether trade in digital products through electronic transmission should be categorized as trade in services or trade in goods. So what parties are clear though is that a digital product is anything that is digitally encoded. A program, text, video, image that is produced for commercial sale that can be transmitted electronically. They just haven't decided if this is a good or a service or both. And today, still, there is no single recognized or accepted definition of digital trade. If you check the definitions of the digital economy agreements, the general consensus is that this includes digitally enabled transactions of trade in goods and services, and that this involves consumers, companies, and governments. So since 2020, Singapore has moved towards free trade agreements to digital economy agreements. And as of July 2022, we have concluded negotiations on 4 DEAs. The DEPA, or the DEPA that I mentioned earlier, the DEA with Australia, the DEA with the UK, and as well as the DEA with Korea. So these look to encompass digital trade rules and digital economy collaborations and seeks to contribute towards the development of international frameworks to foster the interoperability of standards, systems, support businesses, especially SMEs, engaging in digital trade and e-commerce. In addition, DEAs also support cross-border data flows, safeguard personal data and consumer rights, as well as promote cooperation in emerging areas such as digital identities, AI, and data innovation. Singapore also has MOUs with Thailand, Japan, Vietnam, Malaysia, China that look towards the same thing. But then, can you really separate DEAs from the more traditional trade agreements? And I ask this because, if you look at the digital agreement that Singapore currently has with Australia, it essentially replaces the e-commerce chapter of the Singapore-Australia FTA. This is also the case with the agreement with the UK, and I suspect will also be the same for Korea. So this then begs the question of whether or not we can really look at such agreements on its own. Like how some in the US talks about digital trade being the next frontier in economic development in the Indo-Pacific, and whether or not they will always be tied to traditional trade agreements. So this then brings us, to the Indo-Pacific Economic Framework that is being spearheaded by the US. I think that there are clear benefits for the US to engage the region after pulling out of the CPTPP. I mean, it was a major heartbreak for me. I was in the Singapore Embassy in Washington, D.C. when Trump won the election, and then the very next day, I was posted there because I was a negotiator. I was there to help push it through. The very next day, he's like, we're pulling out of TPP, bye suckers. And it was like very heartbreaking for me. So, I think the clear benefits for the US is, you want to assuage concerns about the US commitment to the region. You also want to contribute, they also need to contribute a much needed economic pillar to the Biden administration's approach. In a 2020 report, the Google, Temasek, and Bain & Company found that within the region's major economies, 70% of the population is online. Rate of new users increased at a blistering pace during the course of the pandemic. Southeast Asia's internet economy expanded 5% from 2019 to 2020, reaching approximately US $105 billion. And this provides a lot of opportunities in sectors impacted by the pandemic, including education, travel and tourism, as well as digital banking services. So as you'd be aware, the Indo-Pacific Economic Framework ministers met yesterday after negotiators got together in Singapore in on 13 and 14 July, so about 2 weeks ago, to scope out what each of the 4 pillars in this framework would look like. And so digital economy issues are going to be contained in Pillar 1 on connected economy. And so I'm sure some of you might have already seen what is in the leaked draft text of the agreement. But for those of you who haven't, the US is looking to address online consumer protection, personal information protection and cybersecurity, digital inclusion and open government data, facilitating the use of digital technologies with provisions on electronic contracts and signatures, advancing trade rules that address discriminatory practices in key areas, advance resilient and secure digital infrastructure in areas such as 5G wireless networks, undersea cables, internet connectivity. And all this sounds like what Singapore already has covered in digital economy agreements, but they are also looking to ensure in this same pillar where they talk about digital economy, they are looking to ensure the equitable growth of the digital economy in a manner that supports labor and environment objectives. So it also looks to include agriculture, transparency and good regulatory practices, competition, trade facilitation, gender, indigenous populations, and development and economic cooperation. So bear in mind that there are 14 countries negotiating this, including India, who pulled out of RCEP, and Fiji, which does not have a free trade agreement with any other country before. So 2 questions then for you to consider. Given the larger scale agreements we've seen with the CPTPP and RCEP, can all 14 economies come to an agreement with such a diverse range of countries and with such a diverse range of topics, just for one pillar? And given what I've laid out about Singapore's digital trade agreements not really being able to separate itself from the more traditional type of free trade agreements, how would the lack of market access in terms of trade in goods and services hamper progress when it comes to the Indo-Pacific Economic Framework? I think there's no doubt that digital transformation has reduced costs of engaging in international trade. It's facilitated the coordination of global value chains and connected businesses with consumers globally. But this has also given rise to more complex international trade transactions and policy issues, which are taking place at an unprecedented speed, and trade rules also need to be able to reflect that accordingly. In the digital era, distinctions between goods and services, as well as the borders that they cross, are not always so clear-cut when companies are increasingly able to flexibly operate from different locations where they bundle goods with services and make it difficult to identify particular trade rules that apply to specific transactions. So I'll let the other speakers speak a bit more about how they look at this issue, but just a last point is that I think governments really need to consider that digital agreements are not just digital agreements, but there's more in the package that they need to consider. And I'll be happy to take any further questions later. Thank you.
Thanks very much, Nydia. Shamit?
Thanks very much. So I'm going to move from this very good macro overview that you provided, Nydia, to 2 specific micro items, and it will be in a funnel shape. I'll start with the macro, go into one sector, which is financial services, the sector that I hail from, and then within that I'll talk a little bit about data, which is the area that I spend most of my life in. Just by way of background, you might have some of it, but I currently do work at a startup which is focused on AI ethics and transparency. But for 7 years I was Group Chief Data Officer at Standard Chartered Bank, which operates across the region. And so a lot of what I'm going to talk about is from a practitioner's perspective, the barriers that we have to face as we try to, cross, I wouldn't say cross-sell, as we try to operate in as unified manner as possible across different markets. So take it from that perspective. I don't actually have a lawyer's perspective, although I have come across regulators quite a few times in this space. So let's start with the macro question. I think a lot of the questions that came up, I'm going to try and frame this in the context of financial services. And I think when you think about, in an ideal world, and you could argue whether in an ideal world it should be that all trade in financial services is free or not. I'm not trying to go into whether that is ideal, but let's say if the baseline condition is all trade is in financial services is free, one way of doing a thought experiment is to say what are the barriers to that right? Practically speaking. This is just a thought experiment. I mean, I'm not arguing at any point that all financial services should be free across countries. In my mind, there are three sets that I've seen at least. There's one that I have very little expertise on, except some personal experience, which is taxation related, right? And why I say this is I was trying to open an online trading account recently, like everybody else, worried about where I'm going to get my returns from, given all the inflation. And my bank immediately struck me with what is it called now? The Americans amongst you. Actually, you might not know. The non-Americans have to fill out a form to declare that we are not Americans, and therefore we're not subject to FATCA and its equivalent in the UK. So I had to do something to declare my tax status, because I'm going to access a financial service in Singapore, which is about buying securities in the US. Now that's my personal experience. I'm sure for corporations as well that are selling across countries on financial services, there are tax implications. I know nothing much more about this area, so I'll not speak about this. The second context, which I do have some, so the second level, which I do have some experience in, is industry-specific regulation, which by definition differs by countries, and therefore that poses differences in requirements by country, potentially barriers, potentially diseconomies of scale, because what you can do in one country, you cannot do in another, right? This I do have a lot of experience in, so I'll speak a little bit about that. And then the third one, which is more or less my life's work, is actually the only one that I think is relatively new. And that is variously data privacy, data sovereignty, data ethics, data mobility. You can use various terms, and I have various juicy examples from various countries in this group, some of which I'll give, some of which I won't, because I'll get into trouble over my 8 years, on what regulators seek and the variety of reasons that they seek. Not all of it is on paper, by the way. This particular barrier on paper is very limited. There are very few instances. I think there are people here from Indonesia, from India. I don't know if there's somebody from China. There are very few countries that actually explicitly have regulatory barriers on data on paper. But there's a very big difference between what's on paper and what you're gently hinted to do accordingly, right? So let me talk about those two. I'll speak relatively quickly about the industry-specific barriers, if you will. I'm not even sure they should be called barriers. I think there are differences. Let me take a simple example. In Singapore, if you apply for a financial product, I will say that I am, in my case, now Singaporean, used to be British. So I'll give my citizenship, I'll give my race. It goes down to whether it's Indian or, I think it used to have, actually no, we've got the four, so it's Malay, Indian, Chinese, other. I'll probably give my language, I'll certainly give my gender. Now many of you, particularly from the US, will know that some of these are illegal to use in other countries, even collect in other countries. So when Apple had this major blowback about having a sexist credit card, they were like, hold on a minute, I don't even have an idea of the gender of the people I'm allocating credit cards to. How do I know that? But in this country, it's perfectly appropriate. In fact, there has been no allegation of any kind of ill effects from collecting this, right? And there are many other things like this and elsewhere. I mean, my origins are in India. You could argue whether the state in India you're from, whether the caste you're from, the religion, all of that can matter as well, right? So just this very act that certain types of data can be used to decide whether you can get a product or not in one country, and you cannot do that in another country, is a great example of inter-country differences, right? So that is one. Second could be around the movement of capital. I think, again, if I take an India-China example, there's a lot of issues right now about how much capital was put in from various lending apps from China, and again, there are conduct questions about the local collaborators not necessarily doing the right thing and lending to that. Again, something might be right in one country in terms of how you can or cannot lend. It might not be right in another country. For those of you from the US, with a US background, you know, for example, you're required to give a reason code and an action code when somebody has an adverse financial implication. A reason code meaning, why did I not get the loan? An action code meaning, what do I have to do to get that loan? Now in Singapore, we've only recently, with FEET principles in 2018, that fairness, ethics, accountability, and transparency. It's only in the context of AI that this thing really came up. Before that, this wasn't a requirement. And I don't even think it's a requirement in many of the other states. So the point I'm making is there are a series of requirements that are unique to financial services, whether they are in what is roughly called prudential regulation or in conduct regulation. Prudential refers to things like liquidity, capital, all of these things. Conduct refers to either how you're treating your customers, or it refers to what you're doing in the market. So, I'm sure you know what that means, but insider trading or causing a flash crash is not customer related, but it's still putting the market in danger. Conduct, the other side of conduct is, am I treating my customers fairly? So because there are differences in these requirements across countries, you will automatically have a level of a barrier to this, right? I don't personally think after 20 plus years in financial services that that's a bad thing at all, because different countries have different level of financial inclusion, different levels of financial penetration, different levels of preparedness in the country about what level of maturity they have in, some countries might just not be used to have mass use of derivatives, and you might say don't sell derivatives to the vast majority of products. Other countries you might say it's an appropriate thing to do. So I don't think it's wrong, but it does mean that somebody who's trying to offer services across multiple countries, or you're trying to cross-sell as a passport like EU countries have, it's not that easy always, because you do have to take into account these pieces. But this has always been there. It's got nothing to do with digital, right? Digital has made it easier for people to attempt to sell across countries, but it hasn't actually made these challenges worse. These challenges were always there. What has got much more serious, and where I do think things are very different, I would say the last 5 to 7 years, and it's only moving in one direction. It is not going up and down. And that is, you can call it protectionism, but I think that's a rather cynical view of what it is. People talk about digital protectionism, data protectionism, etc. The real way of thinking about it is, if data is the center around which the world is revolving, data and algorithms, then every country is right in thinking, how do we ensure that we as a country and our citizens are able to keep control of that data, whatever keep control means, and that it is not misused by other countries or players in other countries in one or more ways, right? That's the crux of it, and that finds itself reflected in a few different pieces. One is, inside a country, there are data privacy requirements, which I'm sure many of you are aware of. Most countries will have some sort of requirements which will say what data you can use, for which purposes, how much can you share, what can you collect, etc. These are different by country, by definition. Therefore, again, the previous argument I gave, if you're selling from one country with a common set of practices around the world, it might not work. The way most companies deal with this, by the way, is they try and create a macro level data privacy policy, which takes not the least common denominator, but whatever the equivalent of it, the opposite of it is. Highest common factor, I forget. My math is weak now. But whatever is the opposite of the least common denominator is picked, and that's how you do your privacy if you want to do it across the world. The other more relevant, the more concerning one for many is residency. Now this comes in two forms. One is what I would call, at least for a while, was the Indonesia model. The other is what I'll call the India payments model. The Indonesia model for a very long time was, I don't care where you send the data, but what I do care is that you must have the data at least in my country. If then you need to also export it to other countries because you have to do some kind of reporting, then with certain caveats, you can send some, you cannot send some others, you are allowed to do that. But the minimum is you must not be in a situation where you have to go to another country to get data on my country's customers and payments. The source of this, very important to understand, is with something going back to the financial crisis, which is when large financial institutions fall under crisis, they will go to their home regulator to rescue them. And at that point, it could be that your Indonesia unit is cut off. And if you're cut off and you have no idea where your customers' balances are, etc., because the mother country has kind of got, somehow they don't have money anymore and whatever, then you're in danger. So this thing of being able to recover, I think it's called recovery and resolution, sorry, I forgot the exact term. Recovery and resolution was the driver to a large extent, not just for Indonesia, but for many other countries, to say, you must have everything you need to run this bank and for us to supervise you in this country. If you also happen to send it somewhere else under certain circumstances, it's okay. But it's also not instead. The India payments one, which apocryphally is because of a certain diamond merchant who ran away to the West Indies, was that, or no, to the UK apparently, was that a person who indulged in money laundering sitting in the country, when the central bank wanted to find the relevant transactions, they were told, we cannot give this to you because it sits in another country. Which of course, if you are the central bank, you'll be furious about it. And they were furious about it. It cost a lot of money to a lot of banks. It cost MasterCard the best part of 2 years, I think, the inability to issue new cards in India because they were not able to localize the data. But this is true localization. They're saying you cannot send, they went to the other extreme and said, you cannot send any domestic payment information outside the country. So these are two broad themes. And I have no opinion on this except to say I think both will continue. There are very good reasons for both to continue. I just gave you two good reasons, right? There are other reasons. As somebody of Indian origin, I have repeatedly been told, are you making sure that there are no people in your teams, some of which are in India, some of which are in Malaysia? Actually, I've had both. I've had people in Malaysia saying, we don't want anybody from Singapore accessing our data, particularly after 1MDB, informally, not formally. I've had people in Pakistan say, we cannot have anyone from India accessing our data. We've had people from Taiwan say, we cannot have anybody accessing. Actually, at one point, we had somebody from China say, we cannot have anybody from Hong Kong accessing our data, which is a bit weird. Right? So, and I think all of this is not to be critical. I think all of these are very valid reasons why people, governments, or individual regulators, sometimes it might not be on paper, but individual regulators might rightly be concerned that there are some kinds of access that might not be appropriate. So the point I'm trying to make with all of this is that this has an implication not on the ability to do international trade in financial services, but on the cost of doing it. Because if you didn't have these quote-unquote barriers, which by the way, barriers sounds like a negative thing, I think a lot of this is appropriate, then you could just run your systems in one country, you could store the data there, you could run everything from one place. The moment you're not able to do that, you're then forced to put your machinery, so to say, physically in different countries. But it's not just physically, you also have to carve up your software by country. So you can have a situation, for example, a large conglomerate from one East Asian country did not allow their data to be shared with other countries. The quid pro quo was the other country said, well, we don't want our data to go to your country. So the CFO of that large conglomerate, which had operations in many countries in Asia, could not ask for what's happening to his company's accounts from the bank, because they are only allowed to see the data in their own country. And so they had to ask their deputies in other countries to indirectly give them not the actual raw data, but kind of synthesized data as an example. Now, that's an extreme example, but what I'm trying to show is that it increases the cost of offering financial services around the world. What I'm not saying is that that is necessarily uniformly a bad thing, because there are instances, as we've just given examples, where this kind of data protection might be appropriate. I'll finish with one last thing, which is data was the base. What's coming up on top, and it's still early days, is also the question of algorithms, which you can argue, well, algorithms are algorithms. It doesn't matter which country it's operating in. It doesn't if your algorithm is based on logic. If it's based on if A, then do B, otherwise do C, well, you can know what it is. There's no secret in it. But if your algorithm is, here is how you discover insights about which medicines work, and you train that on one country, you're from company A, and you train it on, country A, and you're training it on country B's data, then there is this emerging thinking that you're harvesting my country B's data, and all the benefits are going to country A. Now, personally, I don't think that is that's necessarily true, because there are ways in which the benefits can be shared. But that is another emerging area that is coming up. And in response to this, and this will be my last point, I promise. In response to this, a set of technology innovations are coming in. If you look up privacy-enhancing technologies, these are technologies that allow you to operate these kind of algorithms across countries without physically moving the data. So in effect, you move the algorithm rather than move the data. So in summary, there are different levels of barriers to digital trade in financial services. There are things around taxation, there are things around financial services, specific regulation. Both of those are important, but have always been there. The thing that is relatively new, though it's at least 5 to 10 years old now, but it's getting tougher and tougher, often for good reasons, are concerns around data privacy, data residency, all, if you want to take a negative view of it, you can call it data protectionism. If you take a more realistic view of it, it's every country looking out for itself, in many cases with the right reason. It's not going away anywhere. So my advice to people who ask me for advice, looking at my past experiences, treat this as a feature, not as a bug. The reality is the world will continue to be in this situation where national jurisdictions want to protect their citizens, want to protect themselves, and will look at ways of keeping access to their data and limiting freedom. Now, how to strike the right balance between that and promoting digital trade is the open question. That's it. I'll take questions after we finish. Thank you.
Sheldon.
Okay, so I'm Sheldon. I'm part of Microsoft Worldwide FSI. So my perspective is more on giving what's the trend, what to look out for when we talk about digital trade and also technology and what are some of the innovations. So before we actually go further into that, right, I just want to kind of set a point of view, right, that there's over 110 trillion asset under management in retail banking worldwide. So,
Sorry, is there a problem?
Oh, okay. I'm sorry.
Sorry.
right, yeah. So as we look into retail banking itself as one part of digital trade or facilitating digital trade on a kind of more of a payment view and etc. Right, we are actually seeing a lot of our FSI clients, globally, looking at their short-term survival and also their long-term growth. So I'm not going to go into every one of that, but you can actually take a peek about what are some of the things, some of the initiatives and projects that FSI, especially in the banking side of things, are looking to do. So as you can see, actually on the short-term side, they are looking to how to deal with the continuous increasing regulatory costs. And one aspect that I can kind of highlight to you is that there are some banks in the region, Southeast Asia region, that have taken on an approach of separating the company. So from a bank, what they did is that they actually split up the company into 10 different subsidiaries, so that they are no longer, holding a banking license as a whole, but the payment department will now become a whole company on itself, and then they are not being regulated by the Banking Act, right? So because the struggle between banks and non-banks payment fintechs has been a long-standing one. I think at least for the past 10 years, you will be hearing bankers talking about how much they have to spend on maintaining the regulations in order for them to survive and continue to grow, right? Where the fintech is not really having to do that. So I think this will continue to be a trend to look out for because I believe that now more than one banks have started to look into that model, and then it's also drawing shareholders' interest as well into that. So as a holding company, when they split up the company, they don't have to, they have a core set of services that can be shared across all the subsidiaries. So I think with this also, we are seeing, the competition between fintech and banks coming to a convergence right now. So we are seeing increasing partnership between, traditional banks, or what we call as the new digital banking license startups, right, and also the fintech joining forces together. So in terms of the long-term growth, with all these, I would say, proliferation and innovations in the industry, using digitization and our technology to kind of close up the gap and to smoothen the processes between payments, they also have to look at the long-term goals because they are changing expectations from consumer, government, corporates. So everybody who are involved in this digital economy have a different expectation post-COVID. And nonetheless, as we thought that COVID is, almost over, but nobody can actually be sure that, we won't run into a circuit breaker again back in Singapore or in any country, right? So this is another thing that we need to look for. But nonetheless, I think what the COVID, I would say the past 24 months have done is that it shows to almost everyone on the planet on how to actually live and work and transact, and then how they can actually look into the other aspects of how to engage customers within the financial services itself. Right. And we can also see that the shift by consumer mindset has deepened. So you yourself is also a consumer, right? And I think that I would say that most of you would not really have a problem dealing with a non-bank, or having any of the tech company doing your transactions, and you might not know that actually most of these companies are already providing some form of payments, financial services, and as part of their subsidiary, right? So you can see that some of these companies have made a lot of news recently, and I think that most of the biggest news nowadays are on tech firms, right? Personally, this is not an opinion from from the organization that I work for, but personally, from the way that I see is that there will be some big shuffle in the tech firms in the next coming years, because some of the services that are being provided by some of these firms will start to see a change in terms of consumer sentiments. So I think that there will be some shuffle around in this area, right? So the next thing that I want to talk about is on digital currency. So I'm not too sure about whether you guys, all of you would have, agree with this definition of digital currency. But digital currency itself, I think what comes to mind for all of us is cryptocurrency, right? And personally, I think that cryptocurrency will continue to make news over the next 12 months at least, because to which extent does cryptocurrency involve, and to how much dollars are being involved in the cryptocurrency market, and this sets across the whole world, right, all the way from Asia into US market. But when we talk about digital currency, it's not just about cryptocurrency, right? So thinking back about digital currency itself, when it was first started off as a product, and then become a marketable, transactable product in the financial service market, what happened was that digital currency was created, as a form of transactable through electronic means, and there were also thoughts about replacing the actual currency with a digital currency, right? So when we talk about crypto itself, cryptocurrency means that it is not supposed to be known who carries the currency and who is holding it, and etc. So there's absolute, privacy and secrecy into who is holding the cryptocurrency, right? But however, as we talk about it today, we know that there is a common flaw in that, when you are putting it into the hands of common people, and then even exploring using cryptocurrency as a transactable form of currency worldwide, right? So that is going to proliferate much more issues. So I think that's one way to watch out for. But when we look at digital currency as central bank digital currency, in short we call it a CBDC, I would say that that's another area that we all should look at, because digital currency held by central bank, technology plus the model of working is being explored by all major economy in the world. And I think that some of the nations definitely have much more advanced in the way that their residents have really take on the form of digital currency as a way of life, right? But what is really happening behind this form of payment is that there are thousands of payment companies or payment services behind, and all having a way to do the settlement behind the scene. So what this also means is that we haven't come to a point whereby we have an agreed upon technology or a network whereby all technology or all payment forms are coming in a way that is highly trackable or easy to kind of tally at the end of the day, right? And some of the related topics to this digital currency that you might look out for are blockchain, cryptocurrency exchange, cashless society, and then also there will be many new, I would say, innovations. Some of them are just in name. It will be called something different, and some of them, will be just a repackaging of what actually is has already came before. So these are some of the topics that I would say that is interesting to research, because I would say such products will come out in any country to kind of entice a different kind of crowd, basically to move funds around. Basically, when there's liquidity in any country, there will always be new products that people are looking for. So some of the topics of interest in this area, if you look at, is that what are the different type of digital currency? As we speak today, there might be a new digital currency that is being invented and being floated around in some way. The law and regulation is not able to keep up with such innovation speed. and also the consumer sentiments in their interest. So there will be adoption by government in their central bank digital currency. And we also have to look out for the adoption by financial actors within the market. And also it will be interesting to kind of really deep down understand what are the technologies talking about when we talk about digital currency. And what is important is really the sentiment and the drivers, because what technology really do is just enable. Right? Technology itself doesn't really create anything, but we just enable the mode of transactions, and also to enable, I would say, the proliferation of such innovations. Secondly, I want to talk about international trade and trade finance digitization. So this is one area that is coming up as an area of focus, especially when we talk about international trade. So for the past 2 years or so, we probably have noticed very lately about supply chain disruption, right? Both from food, consumer products, as well as luxury products. They are all disrupted by global supply chain. Okay. So what happened is that there is also a lot of discussion about how to smoothen the transaction settlement for international trade. So one area that we look at, and we have a lot of organizations around the world, is to do on trade finance digitization. And by way of digitization, what we mean is that we will help to kind of convert the processes and also the documentations into electronic documents, and also to do a lot of processing like text analytics, text extraction, and also we will deploy various new networks as well as new models of engagement, and this is all currently being experimented by financial services firms around the world by forming their own network, right? And these are actually very much experimented on the blockchain technology, which is a similar technology that is being used in cryptocurrency right now. Some of the topics that will be very interesting for you to look at in your respective countries or your area is that what is the changes to international trade law, and also what's the impact to international businesses. And also exchange rate and settlement will be something that look for as well. I think there will be, I would say, regulations and also technology of settlement in the up and coming or ISO standards for financial institutions to conduct their settlements, to look at as well, and how that will actually impact or smoothen, or even in the near term, right? How will that actually slow down the international settlement, right? So there will be a lot of innovations that it will be publicized on trade finance automation and digitization, but do know that all these are very small steps, towards the digitization. So we are still a long way there, and there will be more and more trade finance networks that's being formed up by financial institutions across the region and also globally. And also, one interesting area is to look at how blockchain is actually facilitating some of these conversations and also some of these networks. So topic of interest will be international trade law, supply chain disruption. Where are the disruptions happening right now? What is the impact? And also, what are some of the resolutions that is being found by countries, either regionally or globally? And also, what are the areas of innovation of automation and digitization? What are the new trade finance networks? And also, technology-wise, some of the new technology that we are working with our clients or towards the FSI will be blockchain, AI and machine learning, Web 3.0, 5G, and also IoT. So one interesting thing that I would want to highlight is that, for example, when we look into trade finance automation, just to explain kind of the process briefly, is that when we have a lot of goods that is departing a port going towards the other, their destination, right? Currently, the process is still very much, I would say manual. There might be barcode scanning and stuff like that to kind of determine whether the goods has arrived, and then for the bank to release the funds, etc., through their trade finance processes. So what happened is that there are many more and more, I would say, banks and also nations exploring the use of IoT to track, where is the shipment and the container, etc., so that the whole process can be a little bit more automated through processes and lesser human labor involved, right? So these are the areas that we are currently more involved in, and that's what we see. Yeah.
Excellent. First, we have a question question that I will ask on behalf of a fellow who was not able to be here. So he asks, do you think fintech companies contribute to the shadow economy? If yes, how can it be prevented? If no, why?
I don't know how one would define the shadow economy itself, but if we mean things that are out of the tax flow, which is probably one way of looking at it, then yes and no. Yes, because there are indeed things like, if I'm lending, I used to be a money lender person to person, now I have an app and I've just suddenly increased my scale, that does. I say yes and no because the no part of it comes because earlier it was entirely person to person. Now I have a digital trail, so that makes it slightly easier. Slightly easier for the government to track. And so that has happened in some countries. Certainly it has happened in India. In Singapore, for example, even if you are a fintech, it's impossible for you to lend or do anything without a national ID number and so on. I think there is probably, maybe part of this question was whether fintechs increase financial crime, money laundering and its like. There, I think some forms of fintech do. In particular, if you include cryptocurrencies, not digital central bank currencies, not blockchain more broadly, but specifically cryptocurrencies are most certainly resulting in increased amounts of money going into, or not necessarily increased amounts of money, but more of money laundering is moving, or sanctions, or breaking through sanctions is moving to crypto. I'm not sure whether it's increasing the absolute amount, but certainly there's more going that way than in this traditional financial service.
Thank you. Maria.
Hi, my name is Nydia from CNBC Indonesia. My question is for Sheldon. How do you see the competition between conventional banks and fintech in the short term? Or they actually can be a partner in the future? And in Indonesia, big caps banks, mostly they create their own digital banks, and also fintechs got funded by big caps banks. How is your perspective about it?
Yeah, so my perspective is that the competition will actually be not so prominent in the next 24 months. There will be a lot of partnership agreement and collaboration. I don't think that any of these will, I think the fintech will continue to increase their so-called outreach and also their clients. And I think big traditional bank will continue to lose the client base. I think that's because of the new way of consumer thoughts, expectation, and also the model. Right? So at this phase, what we are seeing is that what you just mentioned about the big banks, funding fintechs is really their way of trying to learn what the fintechs is doing that enable their growth so quickly. However, the traditional bank have I would say, issues that they previously in their own environment it wasn't an issue. But currently, when the economy opened up in such a way, it's an issue. Like I mentioned, regulation is one of the biggest issues for banks, right? And secondly, the way that they operate and the overheads and the multitude of departments that was being set up over the last 40 years for the banks to operate in was also an issue, right? So I think that fintech will continue to grow in that space, and it's really up to the banks on the speed that they try to digitize and also change the model of operation. So digitization is just one way of reaching there, but the truth is that they need to change their operation model. And I think that the example that I brought to you just now about some banks breaking up the bank into various different units is the way that I think that of banks trying to react to that trend that they saw, right? Because that will enable the bank itself to react faster to what the consumer want and also what is up and coming and their competition in the market, right? So previously what they need to do is that they go to the boardroom and then they will need to kind of basically iron it out in the boardroom, and maybe for months they can't really get a decision out. But by breaking it up, you are basically giving leadership and consensus and to each of the head, which is how the fintech model works, right? But increasingly also if a fintech grows too large, right, they will run into similar issues as well. So there are some examples of some fintechs that are growing really large, and I don't want to name them. And then you can start to hear and see the similar issues that So I think the world of the business and the nature is very similar. When you grow too large, it just becomes really hard for you to move as quick as you were before. Right? So this will really depend from country to country. But again, I believe that the fintech model will grow, the traditional banking model will fade away.
How's the regulator should react?
The regulator should react. Okay, so I think the regulator is already reacting in that sense, right? Firstly, when the fintech grows too big, right, and previously it was not regulated like a bank, right, and when issues starts to happen, like if you have more fraud cases that go undetected, right, or you have much more consumer sentiments that is negative, then the regulator will start to regulate them more heavily. So it will come to a convergent point whereby a fintech that grows too large will be then regulated similarly as a bank. So it's just a different speed of maturity that we are seeing there. And by mean of maturity, I'm also meaning about the regulator maturity of understanding of how this fintech works. Right? So that's a growth path for all three parties, banks, regulators, as well as the fintech.
Thank you. There is a concern with the digital trade related concern that trade mispricing is increasing, and through under invoicing, over invoicing, transfer pricing, BEPS technique. So some countries cannot track the digital transaction. So there is a case of corporate tax evasion. So some of the countries cannot track. So do you think international trade laws and existing trade policies are adequately covered these kind of issues? Is it adequately, sufficiently covered to track this kind of transfer mispricing and BEPS technique? And I have another question on FTA and bilateral trade agreement. Since I'm from Bangladesh, we don't have any bilateral. Recently we have just signed a PTA with Bhutan. We don't have any bilateral trade agreement yet. We are import-dependent country, so there's a concern that we may lose our revenue if we sign bilateral trade agreement with other countries. So how this kind of concern can be addressed? Like we are graduating in 2026 from LDC to middle-income countries. We have to open up our economy and we have to sign bilateral and multilateral agreements. And we are also planning to join RCEP. So how could we address this concern? Thank you.
I'll take the first one. Although I'm not a lawyer, so I'll have to take my answer with a strong pinch of salt. But I think there are two different questions in that. And I'm not sure whether you're talking about one or the other. There's a general concern, back to the previous question on fintech, that credit has been mispriced in the last few years because the individuals in newer financial institutions, what you would call fintechs, who are in charge of deciding on credit policies, etc., have never seen a downturn and therefore have no idea at all, no historical memory of how to lend in a downturn. And for that reason, by the way, my answer, if I was being asked the previous question, would be very different on banks versus digital. I actually don't think fintechs, the vast majority of them, will survive. That's a different point. That's like, because I don't understand credit cycles, so I'm mispricing my credit. I think you were referring to something else, which I've read about in a few cases where you have money being siphoned out of the country by using transfer pricing. I don't think that is unique to financial services. There have been allegations of this against very big software firms, against Google, for example, about how much the Irish subsidiaries charged, its money is being made out there, but actually most of it is being charged out through costs, etc. So I think, to your question, is there changes in law? I don't know. I think there is certainly evidence in Europe that even without changing laws, by having the regulators understand the crux of it. I mean, let's break it down. What is the transfer pricing involved in in lending? Well, all I'm doing is providing either credit expertise or some systems that make the credit-driven decisions. So to be able to say, well, how much does it cost to provide the systems? How much does it cost to provide credit expertise? How much of that is coming from abroad versus how much of that is being done in Bangladesh? You don't need new rules. What you do need is the ability to have regulators, or in this case, taxation people, who are able to ask these questions, and frankly, who have the backing of their governments to be able to ask these questions. So when that happens, even very large tech firms that have used some of this route in the past have found that they can no longer do it, and that the evidence of that is in the EU. So, not a lawyer, but I suspect with the right questions and the right tools and the right support, even existing regulators might be able to do a good enough job to challenge that. Yeah, that's my view.
And then go to the second question with regards to Bangladesh wanting to join or wanting to participate in more trade agreements, especially with RCEP. I think the key thing to remember is that trade agreements are always a negotiated outcome, and it's best to understand who you're negotiating with and your partners, basically, right? ASEAN is also a very diverse group, right? You have your big economies like Indonesia, the more developed ones, even though Singapore would beg to differ at calling itself a developed economy by WTO standards. But then it also has these developed economies like Cambodia and Laos, right? So I think RCEP is an agreement that is not your high ambition, high standard type of free trade agreement as compared to the CPTPP. But it is a very easy stepping stone just because the obligations in that agreement are mostly about collaboration, cooperation, and integration, and not so much pushing to accomplish standards that developing economies might find difficult to meet. And unfortunately, trade tends to be seen as a big bad, right? Like, what then happens to your local industries when you open up your markets to foreign goods and foreign services, and that's a big reason as to why India pulled out of RCEP. But I think that you just need to maybe highlight where the benefits are. There's a lot of also, if you look at even in the CPTPP or RCEP, there are a lot of what we call special and differential treatment for developing economies that they can also use to help meet the obligations and commitments. And I think RCEP is definitely one that a lot of developing economies can aspire towards.
John?
Hi, this is John. I'm from Global Finance. I'm based in Tokyo. A quick question for Nydia. You mentioned that Singapore and Japan has this an MOU regarding digital trade. How far has that moved along? And in your experience, what are some of the stumbling blocks when it comes to negotiating with the Japanese side regarding trade? And a question for Shamik. You used to work in a bank, and now you're in a startup, and you've also worked with regulators. What advice do you give startups when they're negotiating with corporate partners and also with negotiators in an area that is still under regulatory uncertainty? And for Sheldon, I noticed that Microsoft is not listed among the companies that are non-banks that have moved into banking. Is there any breaking news on whether Microsoft is going to move into the non-banking retail sector?
Maybe I can answer this first because it's fairly straightforward. So Microsoft is definitely not moving into fintechs or banking sector. I think the key message that we are sending across and also very aligned is that we enable our clients. We don't compete with our client, and we have no aspiration to become a fintech. So we remain as a technology company, and we remain focused on our mission. So I think that is the answer.
So on this...
Sorry, you're not onto cryptocurrency development, Microsoft?
Okay, so sorry about that. I just want to answer this now. We enable some of the cryptocurrency, I would say, innovations, but we are not directly involved in the creation or the marketing of it. So I can also tell you that there are some I would say, major form of cryptocurrency that is started with our technology as well, because we enable the framework, the network, etc. for the transmission and also the, I would say that the tally of all these, in a very quick, instant, and also, a way that is able to be seen by all parties within the network, right? So, however, Microsoft does not have any cryptocurrency under our belt, and we don't have any intention to release them.
So just going to your question on the agreement that Singapore has with Japan, it's an MOU on digital economy, AI and cybersecurity and ICT. So this was actually signed in July 2021, where both countries will basically collaborate on exchanging information on best practices, policies and regulations relating to digitization, AI, cybersecurity, and as well as deepening partnerships on joint initiatives to promote and support the growth of digital trade and the interoperability of frameworks. I suspect that most of that discussion will happen on the sidelines of IPAF. And I would say that, in terms of my experience of negotiating with the Japanese, they tend to be fairly allied with the US. So when I was negotiating the TPP, that was how the US would try to get us to cave on language, because they would be, and this was just before Japan joint negotiations, I think in like 2012, 2013, and they would be like, Singapore, you need to agree to this quickly, otherwise, when Japan comes in, you'll be outnumbered anyways, so you might as well just like fold now. So I think that was a bit of a con, and they're also very poker face, so it's very hard to try to get to what exactly are their key interests. And it takes a couple of rounds before you get to really know and understand them, which I think is fairly typical of Japanese people, but feel free to correct me if I'm wrong, but yeah, that was my experience with the Japanese.
That's very good.
On your question, what's my advice to fintechs in dealing with banks and, with startups? I actually hate the word fintech because it absolutely means nothing. Who is a fintech? I mean, the oldest fintech in the world is arguably Reuters, which is now LSEG, because it used technology to transfer financial information, right? So never mind. I think you are startup, so I'll answer it like that. I think slightly different things for regulators in terms of your question on what to think of. I think when you're working to either partner with or even compete with large financial institutions, keep two things in mind, and they will sound paradoxical to each other, but they're both true, and they're both true at the same time. One, traditional financial institutions have often attracted, if not the best, but certainly they're paid a lot, and whether they're the best people in some objective terms, I don't know, but they're reasonably clever people in a more intellectual sense, right? So do not underestimate how difficult some of the problems they face. And a very good example of this is it N27? I forget what the German bank, neobank is called. They're banned from onboarding any client in various countries. And they're extremely frustrated. Revolut, another UK one, extremely frustrated that the FCA is not providing them the licenses they need. Well, they're frustrated because every other bank in the world is trying to do detailed KYCs, and they think this is not something they need to do. So the first part is, guys, there's a lot of very highly paid people in the banks, and if you take pay as a proxy for why do they need all these people, it's complicated. So don't underestimate the complication. The flip side of this is that there's a very large number of highly paid people in banks, and they have to invent a lot of work, and as a result of their invention of work, they're very costly. So there are opportunities whereby really attacking, the underlying problem, you can actually get an advantage, right? And so what it boils down to, coming back to that Indonesia question, my view is in countries where financial services is not serving all the people, which includes large parts of Asia but does not include Singapore, there is a real opportunity for attackers enabled by technology. I will use that term. Not fintechs, not banks, not neobanks. For attackers enabled by technology who say, I don't care what. So in the example of Indonesia, I think Bank Jago bought the bank license of an existing bank. But really they're saying we'll build it from scratch, right? So there is an attraction in countries where financial penetration, financial inclusion is not high enough for people to build something from scratch. But the value of that is not because they're a fintech. The value of that is because you're building something from scratch and you're not dealing with a lot of the mess, right? So that's there. That opportunity is there. It's far more difficult in countries where there is a mature financial market. It is extremely difficult for any of the neobanks to make money. Notice in Singapore, DBS is not building a neobank. The one bank, which is the world's most digital bank, has decided not to build a challenger bank. Why? Because there is very little a challenger bank will do that they can't do themselves, right? So that's my view on the competition side. On regulator, I will give you, I think there was a question, how should regulators approach this? I will give you the extremely professional view of how regulators look at fintechs increasingly, which is, if it walks like a duck and quacks like a duck, treat it as a duck. That is increasingly the very scientific approach that they're taking, which is, guys, I don't care whether you call yourself a fintech or Timbuktu. Doesn't matter. If you are lending, you will be subject to lending regulations. And that includes everything that goes with it, right? So I would say initially for most startups, there is a period when they will get a little bit of grace, a little bit of rope to say, well, you're small, you don't matter. But the moment you start mattering, you will be subject to the same law. Any good regulator will do that. That's something to keep in mind.
Yeah.
I'm Shruti from Bloomberg, Delhi. My first question is, you say that fintech is the way to go, traditional banking will fade away. Does it mean that CBDC is likely to replace the physical currency? I mean, because many countries are developing their own CBDCs, right? So do you think that's going to happen anytime soon or in near future?
Shannon, you might have to answer this. I don't believe banks are going away. I don't believe fintechs are going away.
Okay, I think this is the way of perspective, right? So I would say that all major economy inspire to create CBDC and roll it out to the whole country, right? But understanding that it is a major feat to accomplish for any nations, even as small as Singapore, right? So I would say that the inspiration is there, and they are definitely exploring ways, models, and I think that China might be a bit more successful in the way of having a digital currency in their residents' way of life. However, I would say that I don't see it as something that will replace traditional currency even in the next 5 years. Right? But this trend and this focus of innovation will continue to grow, right, regionally, into finding and innovating new ways to transact between regions for goods across regions. So I think that CBDC might transform into something that is targeted and inspired to work in a similar way, but I don't think that it will ever replace a physical currency, in the next decade, because of the complexity of rolling that out in real terms. But if you talk about technology-wise, it is already something that can be experimented freely and to be used. And the only thing to do now is really to round out all type of e-wallets and payment methods. So I think that if you in your own country, or even for you might be facing at a 7-Eleven or any store that you go into, that you can have at least 6 or 7 different way of paying method through one phone. Right? So that is actually I would say that there's just too many of it. And I think as a consumer, we are getting lost in that. And anybody would have imagined about if that continues to grow, some will actually fall off as one of it, right? And then finally, maybe that's where governments, central banks are going towards, to become that one central hub, whereby all these approved, tested methods that residents choose. Right? Because right now it's still very much as you have the choice. But when it comes to CBDC, means that you don't have the choice. We make the choice already. Just use this. Right? So that is going to be really hard. Right? But if let's say there's benefit of that, there's clear benefit of that, right? So that is something that I would say that it will continue to grow and innovate in that area.
Yeah, maybe should be too on the financial, not technical aspects. The choice, if the question is, will CBDBs do away? It's got nothing to do with fintech or not. Will CBDCs do away with the role of retail or with the role of banks? That is a design choice. And I think Ishwar Prasad's book on money is a good one to look at. There's a design choice between whether you're talking about a wholesale CBDC or a retail CBDC. And if you choose a retail CBDC, if you choose to go down the full retail CBDC, then yes, the logical thing is the role of banks will shrink, commercial banks will shrink. But it's not clear yet that most central banks are wanting to go down that route. And so if you use the more wholesale CBDC thing, which is I am not going to, as Reserve Bank of India, I'm not holding accounts for Shruti or Shami, I'm holding accounts for the intermediaries, then I'm not sure that will do a huge amount in terms of the threat to traditional banks. Yeah.
Okay, and also as a follow-up to this, with more proliferation of digital fintech technology, what do you see any charm for companies to actually go for tax havens? Like, do you think the charm of tax havens going down with more proliferation of technology?
Logically yes, because there is very little opportunity to hide. The one exception to that is back to cryptocurrencies, which is if you are permitting, I mean, it all boils down to where, if you're permitting translation of your fiat currency into cryptocurrency and back, then there is obviously the opportunity. And many people say, at the start of the Russian sanctions, there was a significant shift into cryptocurrencies, as an example. So with that one exception, that aspect of financial technology innovation, the rest of financial technology innovation actually makes it more difficult. I go back to use tax havens. I go back to my original example of my Singaporean broker asking me for my FATCA details before they allow me to trade. But by definition, my tax information is now being shared with the US. So yes, but one exception being cryptocurrency.
Okay. And my last question on the trade agreements. So, a lot of countries, including India, they're coming out with their data protection policy, data privacy, localization, all those things. They yet to come up, but they're coming up with it. How difficult do you think it will be for a bilateral or a mini multilateral arrangement to work in terms of digital agreements if each country comes up with their own system? How difficult will it be?
I think when you look at trade agreements or even these kinds of digital agreements, countries always negotiate understanding what is already in their domestic system and then trying to find commonalities with their other countries, looking at areas where there are interoperability. So I think that, even as countries look towards coming up with their own policies when it comes to, data protection, data localization, data privacy, I think they need to look at, they need to come up with what is in their best interest, right? What is in the country's interest, both in terms of the public sector as well as the private sector. Because at the same time, companies also need to grow. Companies also need to be able to internationalize, and they need to take that into consideration before they negotiate with other countries. But then that's it, with India being part of IPEF, and in that stage where policies have yet to be formed, then they need to find that right balance of whether or not they want to sign up to the trade pillar or if they want to prefer to sign up to other pillars first before they look at the trade pillar to look at what's in the digital economy provisions. Because once you sign up to international agreements, whether it is RCEP, CPTPP, ASEAN type agreements, even the ASEAN and the India agreement, if there are going to be any digital provisions that are there, they also need to consider what are the existing international agreements that they've signed to make sure that whatever policies that they do ultimately decide to come up with don't fall afoul of whatever they've committed already. But I suspect that a lot of countries like to give themselves a lot of wiggle room anyways to make sure that when they do negotiate these policies, that whatever policies that they come up with will still be somewhat kosher.
Anyone else?
Hi, I'm Hiji from South Korea, Seoul. I'm working at Bloomberg News, and then I want to ask a question to Mr. Go. It's a pretty general question. I just want to know how you think about the crash of Luna. The CEO happens to be South Korean, and South Korea is also known as one of the hottest market for cryptocurrency. I just want to know how you generally see the case, why this happened, what can we learn from this incident, and how the government should do.
Okay, so this is very interesting. But before I say anything, this is not the view of Microsoft, it's just my view. So looking at cryptocurrency, I think a few months back I was also participating in another forum by economists on the use of cryptocurrency as a payment. Right? So firstly, in my community, we always ask the question is, what is cryptocurrency? Do you have an idea about what cryptocurrency is, anybody? Actually? Okay. So I think the meaning and definition of cryptocurrency itself has changed a lot, and it's changing by we speak every second, right? So the way that I see is that it is created as a medium of speculation, right? So other than a medium of speculation, there's really not much things that, from the way that I see it right now, right? And the lunar crash, it can happen to any major cryptocurrency from the way that I see it, because there's really no basis in how that currency value goes up and down, right? So, and that differs from fiat currency or even CBDC if we speak about that, because there is a major value goods economics that is behind, the value of that, and then there's major well-known system that we all probably might have learned before. So for cryptocurrency, it's still something that although we talk about the technology, etc., but nobody is really able to explain what their cryptocurrency is basically tech on. So on the high side of what has already happened, right? We have seen the major crash of Luna, which is one of the cryptocurrency, and then we have the recent, I would say, exchange that is also fallen due to this, and I believe that there will be much more that will be uncovered as well. And I think that my sentiment is that it is up to all of us to learn about what this is about for all of us. And I think that just one thing that I know is that I think South Korea has already been mining cryptocurrency for some years. There was already a craze of purchasing GPU and then mining that. And when I ask people, do you know what exactly it does? They say, no, somebody just tell me that it makes money. Right? So anything, you move away cryptocurrency, anything that people tells you that it makes money and you believe in that, it's going to crash. That is for sure. There's no second doubt about that, right? So I think the key thing is always to look out for how these schemes came about in your respective country. And I think the right thing to do is to find out and report it as soon as possible so that you can prevent more and more people from getting involved and have that. Because the government, they will not be able to report into this or to really go into that. And actually, just to a certain extent, right, Singapore government has already turned away granting licenses for much of these exchanges, right, for reasons that they do not want to overly explicitly explain, because they still want to have legitimate financial services to come in, right, and therefore, but of course not every nation supervisor will have the time or the bandwidth to do that, I guess, right? So many a times it just breaks out way before authorities can step in, right? So I would say that this is a learning experience, and cryptocurrency is a new term, but if you look at the history of financial services, you might have seen schemes that happen like that happen before. So that's my take on that.
Hi, Ben Westcott from Bloomberg, Australia. I love your use of the word schemes when describing cryptocurrency. It's and I find that really interesting because Australia's on the brink of examining how to legitimise, legislate, and try and officialise in some way cryptocurrency. So my question to you is, I mean, given what you've just said about it, do you think that it's worth countries trying to legitimise these cryptocurrency by trying to legislate it and trying to control it, or is it somewhat pointless to a certain degree? Does it eliminate the purpose of cryptocurrency as a sort of bizarre scheme by trying to legitimise it?
Yeah, I'm going to give a not professional answer to this. Probably I'll leave the more professional answers to. Firstly, is it worth? They have to. It's not whether it's worth or not, right? For any legitimate business that comes in and try to set up, I would say that the government will need to understand what the business is about, what is it offering to the people, and what is the value of banking, right? And therefore, you cannot prove that it is a scheme, right? But of course, when something falls, then we know that it's a scheme. We can legitimately call those as a scheme, right? So that is my unprofessional view. So it's not really worth or not worth what government do have to do. I think government does a lot of things that is not really worth as we speak, but they still have to do it because they have a supervisory responsibility to the people, and also the growth of the economy is also on them. So we can't turn away people who want to create a legitimate business here, but at the same time, we might be saying no sometimes to things that we don't understand, or the corporate fail to provide those information for us to access them.
Maybe if I may just add, I think it might be worthwhile to think of the three reasons why you might want to regulate. And my view would be two of them would force the Australian and any other government to intervene. The third, they might have a choice. The two that will force them are the ability to use cryptocurrencies for money laundering and financial crime more broadly. Not just money laundering, but cyber threats also often get paid off through cryptocurrencies. And the effect, the contagion effect on the mainstream financial services. So if you have a strong amount of correlation and connections between the regulated financial services and more money is moving both ways, then as you would have seen, there's a little bit of concern that contagion will force people in the mainstream markets to collapse as well. So these two are good reasons for regulating. The question mark is on the third, which is consumer protection. Since you're all journalists, you would have heard of The Onion. There's a very nice article on The Onion today, which is about, I'm shocked that I didn't have another 1,000 people warn me about the dangers of cryptocurrencies, right? Of course, it's tongue in cheek. But the point is, there is a genuine argument, which is, if despite lots of warnings, people are expecting 18% interest rates, is that the government's responsibility to protect them? There's pros and cons. I mean, if that causes social unrest, you might want to do it. If not, you might say, yeah, tough luck, you made your choice. But for the other two reasons, you do have to regulate. For this one, open.
I think governments, when it comes to emerging tech, has always had to tread that fine line of deciding when, if ever, they ever want to regulate, right? I mean, if you look at when Uber first came into the picture for ride-hailing, governments didn't really regulate until the regular cab drivers started protesting. And if you look at, even in the digital economy agreements that I was talking about earlier, there isn't really much to do with financial services in terms of obligations, except as it relates to e-payments. And you can see that the government is kind of like, governments are still observing that space. Singapore, at least when it comes to such developments, they always prefer to let things shape out for a bit longer before making a decision. That's definitely the case when it comes to AI. They have verification frameworks in place, but nothing specific when it comes to regulations. And with CBDCs, even MAS has come out quite strongly to warn people about the dangers of crypto. But then at the same time, they want to make themselves the crypto hub, right? And so they acknowledge that blockchain technologies can be very, very useful. But so how much warning can they do before they actually start regulating? I think that's a fine line that governments need to figure out how to tread.
Yeah, 2 weeks ago we have seen a story, investigative stories by all around the journalists about the Uber. How can the governments regulate such kind of services, like it's a kind of digital services, online services that provide transportation in various continents around the world, but they broke laws and they lobbied in the government?
I don't think that, at this point, like what I mentioned earlier, governments are still very iffy when it comes to digital services, right? They don't want to say specifically that, oh, this is a trade in service or a trade in good. I think currently governments are regulating that in terms of transport services, and I think that that's going to be the case for Uber, Grabs, Gojeks. But as these apps start growing and start venturing into like different areas, I think that's where the water starts getting a bit murky. And I don't know if governments have a clear sense of where they can be regulated, except as and when they come up into like certain very specific areas, right? So even with Grab, you have transport services, but then they are also a financial institution in some sense. So then they get regulated under that. But then where the food delivery comes in, is there regulations for that? Probably in the Food Safety Act, but there's so many different things, right? And so like, I don't know necessarily that governments can really find a comprehensive enough area to look at it in a more holistic manner.
Yeah, I mean, the only thing I'd add is a lot of the issues that came to light with Grab, I mean, aside from the lobbying, etc., sorry, not with Grab, with Uber, they could have been addressed through data protection and privacy laws. So I think governments that pay attention to that aspect, that already allows you to take care. So there was an instance of deletion of records. Well, actually, most data protection laws require a certain amount of data to be kept for a certain number of years. So you don't need a Uber-specific law or a transportation-specific law. You can use data privacy laws to say you cannot remove that data, that piece of data about all sexual assaults in the last year, which was removed, I think, in many countries. You couldn't do that, not because of some Uber-specific law, but because of privacy or data protection law. So I would say, again, with the right mindset, even existing regulation, you mentioned Food Safety Act, Financial Services, so Grab has split up, obviously, GXS, the bank, from GFS, which is the parent, which is different from the Grab main group. And the financial services part will be regulated by financial services. But I would say the data laws in particular do provide a good way to make entry in that situation, for example. But there's no answer to large-scale lobbying. I mean, if there's large-scale lobbying into senior political roles, that's not related to what the law allows.
Final question goes to Martha.
Yes. Martha from Kakadata, Indonesia. There were concerns about the risk of digital conglomerations, whether it is going to amplify the systemic risk in the financial institutions, financial system. The concerns were there in 2000 and in 2021, in 2020 even. But I'm curious, is it still a concern nowadays? And if you think it is, then how big it can be and how dangerous it can be in Europe and end. And the second question is, in this time of automatic exchange of information, do you think that cryptocurrency can be seen as a new tax haven? Or because it has no basis, then it can be seen like that?
So
I just want to know your
just say
opinion.
one point, right? If you have a lot of money and you want to put it into something that can collapse, and you think there is a tax haven, go do it, because I don't think government cares about that. So that's specifically, I think, the stand, right?
Yeah.
So personally, I don't think that, yeah, you can see it as a tax haven, but if you are not concerned about stability, which is definitely not there, then that's one.
I couldn't answer it any better. On your first question, were you worried about financial contagion?
Yes.
Yeah, I mean, I'm not sure digital makes the risk of financial contagion any worse. I mean, there is a line of thinking which is because information travels much faster and a lot more people. I mean, one example of this could be meme stocks, for example. You can argue it is a form of contagion. One person does something on a Reddit channel that leads to it. So one argument is faster flow of information and enables more disinformation, more herd mentality, etc. that can cause contagion, yes. But the flip side of that is that there's also so much more information that you can build in automatic circuit breakers or triggers that can prevent it. So I'm not sure it's unidirectional. There are forces through digitalization that push towards greater contagion, but also greater digitalization provides regulators with the means to check those in time. as well. I mean, there are some risks, like the risk of flash crashes because of algorithmic trading errors, etc., which do indeed become more difficult. So one macro point I would say is that the less humans understand about the flow of data and tech that is driving financial services, the more risky it will be. So as data and algorithms become more important, it is important for humans, both the financial services and the regulators, to have a good amount of understanding of how those work. Without that, contagion risk doesn't exist.
I just want to kind of confirm whether you are asking about the rise of conglomerate, digital conglomerate,
Okay.
raising a concern, right? So it's like Gojek and
Investors behind
Tokopedia,
it are
so that's where it is, right?
Thanks.
So I think if I use that example, personally I don't think that is a huge concern. Conglomerate has grown in every country across a span of services. So digital conglomerate is no different from physical, services providing conglomerate, right? So I don't think there's a major concern as long as everything is reported with transparency, everything according to your financial reporting, etc. And I think that it's actually a good growth in a way because a lot of the issues and then the data that's being shared across, and stuff like that. So if it's according to, I would say that maybe the supervisor or the government is also looking for ways, from the way that I see in the region, to connect and to get a feedback loop from bigger conglomerate, right? So actually I see that as a very positive effect. Because government has always been known to be less connected to the resident, right? And the financial services or any services is more connected because of obvious reasons. They want to get client services and everything, right? So I see that this is actually a good mix between both. And the digital economy actually enables that under the right rules, security, and the framework that is, I would say that now it's also being shared across in the region. So I think ASEAN government is sharing that. There's a lot of talks about sharing what we are doing here, over there, and stuff like that. So these are actually really good. And I think that Indonesia is a place that we have tons of data that is flowing, and that's really helping the region as a whole about how we see this growing.
Is it possible that it makes the government actually protect the big conglomeration instead of protect the small P2P lending startup? Because we have like this omnibus law for financial industry. It's just only suggestion, but one of the points is they want to raise the minimum capital for P2P lending startups. So for big caps, it's of course easier for them.
This is a difficult answer because I'm not from the government, but whether there's any sense for government to protect more of the bigger corporation, I would say yes. Because if a bigger corporation falls, there's more impact that is going to be impacted, right? So they did it for the protection of consumer, right? So, but they don't do it just simply because they grow big, but they do it because it will impact more.
There were actually concerns about, whether if one day an e-commerce company would fall, and then if it is in one conglomeration, I mean in one conglomerations, I mean with the financial sectors, they have also banks and fintech and e-commerce, and e-commerce fall, and then everything, the rest will be affected by it. So I think that was a concern in back then, but I don't know whether today it is still a concern or not. But probably what Maria said that the Indonesian government is actually expecting that the fintech and the e-commerce will amplify their capital and things like that to make them more prudent like a bank, because they are in one one conglomerations, right? So what I really questioning before is that whether it is really a risk right now, because in your opinion, in your views, whether actually it is quite strong enough, these conglomerations, to really support the economy and wouldn't bring the risk to the economy.
I think I understand that. But I don't think that a nation economy is supported on just one conglomerate, right? And I think that also talking about just bringing back what Xiaoming has mentioned, if it looks like a duck, they will probably regulate it like a duck. So it's just that they are probably now looking at ways on how they regulate that. Right? Firstly, they can't use the Banking Act on these companies unless there's a banking unit and a lending unit there. But now the Banking Act has already extended to anything that lends money. Right? And then there's laws that are governing that. So my take is that it's a good worry, but I think that if you look at some of the major e-commerce in the world right now, you've probably seen some of them are not doing that well as well. Right? So it's a global concern, not just
In Indonesia.
it's not an Indonesia concern, right? So and again, a lot of these are in a stock market view, right? When our current economy with inflation, with the rising interest rate, and also the war and everything else, right? We are just in for a ride to see what comes next, right? So a lot of this e-commerce that previously was riding the wave, right? What goes up?
Yeah.
I didn't say that, but I'm just going to say that what goes up, right? So.
Well, it's a really complicated issue, so thank you for helping us tackle it today.